Welcome back. Market stable above 5900 gives us the opportunity to tackle something off the market. This time it's the personal finance segment, and Hemant Rustagi of Wiseinvest Advisors is going to be with us for the next two segments to speak about mutual funds. What should you be looking at when you're selecting a mutual fund? And the topic on our radar today is whether you should be checking the size of the AUM before you invest in the fund. Before we get to Hemant Rustagi, we actually called SBI MF today on our show Bazaar, and the fund manager handles three portfolios, of which the fund that's outperformed actually had an AUM of about 350-400 crore rupees. The other funds, he's managed to gain well, but the smaller fund gave him a return of 54%. So could AUM be a benchmark or something that you should be looking at? Hemant, what's your view on this? Do you believe smaller funds have the capability to outperform because their mandate is smaller and they could invest in smaller stocks which tend to give you higher beta or higher returns?
Well, a fund can become, unwieldy to manage if it grows too large. But I think we need to also understand that the impact of the fund size and the performance will clearly depend on different factors. The factors are what is the asset class that the fund is investing in, and what is its basically investment strategy and philosophy. Now, for example, if you look at a pure large cap fund or a fund which invests predominantly in the large cap stocks, the size of the fund will not impact the returns negatively at all. That's because the fund manager will have no problem in buying and selling stocks at any quantity at any given point in time. So similarly, if you look at the debt funds, like you have funds like liquid funds or ultra short-term fund or a short-term fund or to a large extent even income fund, the size of the fund will not impact the performance. But if the fund outgrows its investment style, then it can make a difference. Now, for example, if you look at a mid-cap fund, now the major differentiator between a good performing fund and a poor performing fund in mid-cap category is the stock picking ability of the fund manager. Now, if his fund becomes too large, the chances are that he might have to be compelled to compromise on the quality of the portfolio or the liquidity in the portfolio. So, and as we know that this segment of the market remains under research and there aren't too many opportunities here, and the fact remains that these companies have the potential to do well over a longer period of time, and these funds do attract large sums of money, especially when the markets are doing very well. So in a way they become victim of their own success. So if it's a mid-cap fund, definitely make a difference. If it happens to be also a sector fund, if it becomes too large, the fund manager may actually struggle to find good quality stocks in the portfolio. So the fund size can have impact, but clearly it depends on, like I mentioned earlier, the asset class that it is investing in, and also what is the investment style of it. So some funds like value funds, sector funds, mid-cap funds, thematic funds can get negatively impacted if the fund becomes too large. But the rest of the funds, I don't think the investor need to really bother about the fund size. They just need to focus on what is the quality of the portfolio and how consistently the fund has been doing vis-a-vis its benchmark as well as the peer group.
So is that the way to go about then, Hemant, very quickly? When you are choosing a mutual fund, just go to one of these mutual funds online websites and check out 90-day performance, 1-year performance, 2-year performance. Actually, they don't give you beyond 3 years. But is that the way to go? The one that has consistently a higher return is the one to go for?
Well, definitely performance is one of the key parameters, but it can't be the sole criteria for investing in a fund. And especially, even when you're looking at performance, I think one has to look at a longer term, especially in equity funds. You need to look at 3-year, 5-year, and even more. If you go to the mutual fund website, and there are other portals where information is available for the fund performance for the last 7 years, 10 years, and 15 years, I think you need to look at how consistent the fund has been in terms of performance. And of course, the key factor is also the suitability. Investors need to make sure that the fund they're investing in first should be suited to their investment goals and their risk profile. Thereafter, like I mentioned, in some category of fund, the size of the fund should be looked at, and I think investors need to keep an eye on that. For rest of the funds, I think the consistency in performance and the suitability are major factors to decide.
Fair enough. There are more questions lined up for you, Hemant. We take a break and we are back with our viewers and their questions. Welcome back to Markets and Macros. The markets have done a little better since, say, 11 o'clock or so, and we are seeing some bit of improvement, not just in the heavyweights, but also in the mid-caps and small caps. So 5,900 within control at this point in time. We were discussing personal finance, especially what you should watch out for when you select your mutual fund, assuming you have already checked suitability, whether you want a debt fund or an equity fund, and whether you want a mid-cap or a small or a large-cap fund. Should the size of the fund be very important in your decision-making? We've been speaking with Hemant Rustagi, and now there are other viewers who have questions on the issue. Shirish Kanetkar from Pune joins us. Go ahead, Shirish, your question.
Yeah, many people are advising well-performing funds like HDFC Top 200, whose current NAV is more than 220 rupees. My question is that, like in equity, sometimes when the stock prices have run up too much, experts say their valuations are too expensive. Is there such a concept for mutual funds also, or can NAVs of mutual funds keep increasing infinitely?
Most useful. Tell us, Hemant, I'm sure this is something which every investor should know.
Yes, Lata, definitely. I agree. And Shirish, I would say that, it's always good to, invest in a fund that has done well over a longer period. Because when we talk about, considering a fund which has a good performance track record over a longer period, which basically confirms that the fund has the ability to, perform in different market conditions. But, what we need to understand as an investor is that there are two options in a fund. You have growth option and a dividend payout option. The dividend payout will continue to pay dividend, periodically, maybe once in a year or sometime twice in a year. But in the growth option, the NAV of a fund will continue to grow and become high over a period of time. So basically, it reflects the compounding effect of growth in a fund. So I think as an investor, it's very important for you to understand that it's the quality of the portfolio or its investment strategy which matters, and not the NAV, because NAV, as I mentioned, can become high over a period of time. So in fact, I would say that investing in equity funds is akin to investing in stocks. You talked about valuation. When you invest directly into the stock, obviously you need to track valuation, looking at PE or price to book or various other factors. A fund manager does exactly the same on your behalf when you invest in a mutual fund. So he keeps making decisions in terms of exiting from particular stocks or investing in them, or holding them on for a longer period. So yes, the parameters which are applicable for investing in the stocks are applicable in the mutual fund, but the key differentiator there is that all the decisions in this regard are made by the fund manager on your behalf. As far as you as an investor is concerned, I think, as I mentioned earlier, what matters is the quality of the portfolio. And remember, all the decisions that a fund manager takes reflects in the performance. So if your fund is performing well vis-a-vis the benchmark as well as its peer group, I don't think you need to really worry about the NAV level. In fact, the right way to look at higher NAV is to look at it as a reflection of compounding effect on the NAV over a period of time.
Okay, and Shirish, the other point is that the basic difference between the two is while the company's PE may be restricted by how much the company can grow in terms of earnings, which depend on a lot of things, the NAV depends largely on the fund manager's investment style, how well informed he is, and his balanced approach. So it's a completely different concept in terms of comparing the PE and the NAV. NAV can continue to rise higher if the fund manager's style is good, while the PE has a lot of constraints in terms of the earnings growth. So it's completely two different things that they're trying to compare at this point. Okay, so moving from Shirish, let's also...
Well, I think we don't have any more questions.
We don't have any more
left. We've run out of time. Thanks, Hemant and Shirish, for joining us. And to you viewers, a note, do join us at the same time tomorrow. Harshvardhan Rumta will